What is up, YouTube, and welcome back to another Fridge Financials video. And today's video is a video requested by someone on After Hours. Shout out to you. Good timing for supporting the channel as per usual on After Hours. And the video we're making about here is about cash secured puts. More or less, why is it that some stocks give you better returns for cash secured puts compared to others? And there's quite a few things that we need to factor in and consider as we're looking at selling cash secured puts. So if you're excited for today's video and you're curious to know what we're going to talk about, always feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future uploads. So Good Timing wrote on After Hours to me. He wanted to say, hey, Bridge Financials, I know you make some quality videos. That's a biased opinion that I'm putting in myself, of course. But he said, I was just checking out a few stocks and saw that some had good returns on premiums and some didn't despite the strike price, and wanted to see what made a good cash secured put to sell. And he said, don't make a video. And I said, of course I will, because I love when people ask me questions. So if you do want any other videos, also drop them down in the comments section. So we're going to break down a couple things here about how cash secured puts works and the idea behind what's good. Why do some stocks have better returns, quote unquote, better returns compared to others? So again, if you look at a cash secured put, basically the idea behind it is that you are selling an option. So in the options chain, the options world, you always have buyers and you will always have sellers. As an option seller, you will be getting paid a premium up front. And as an option buyer, you're paying that premium basically for the contract. So if you wanted to sell a cash secured put, I put the example of Robinhood because as you look at Robinhood, it's been absolutely mooning since 3 months ago almost. It's just straight up rocket ship to the moon here. And you're thinking, well, Fridge, I'm thinking that Robinhood's going to pull back a little bit. It's coming in really, really high, really quick. It's bound to have some pullback here. So here's the thing to say, well, Fridge, I want to sell an option here. I want to get into Robinhood, but I want to get in at a cheaper price. So you want to go to, say, maybe August 15th, about 22 days out here, and you want to get in maybe at like $90, for example, here. What this will happen as a result is that you will sell this option here, and you will be paid $2.20 something cents, whatever you get filled at in this case. You'll get paid this amount upfront per share. And as a reminder, again, options trade in 100 shares, so you would get paid around $220 something for this option here. But what that means is that if Robinhood goes to $90, you will then have to buy 100 shares of Robinhood at $90, which means that your cash collateral would be $9,000 here. And so that's how cash secured puts works. Now, there's a lot of things that factor into how some options and some premiums pay you a little bit better compared to others. One thing to keep in mind about, obviously, is going to be upcoming earnings reports. Okay? Because earnings reports obviously will increase that implied volatility. And the idea behind it is that the higher the implied volatility of a stock, the more premium you will generate as a result. Okay, what I like to do another show's idea here was, say, taking a look at Yahoo Finance. Here we have Johnson & Johnson. Johnson & Johnson is a ticker that has been around for many, 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 many years, has been a dividend payout stock for so many years. People love having in the portfolio. And think about why people love to have in the portfolio, especially if we have downturns in the market, if we have a recession that happens by some chance or a correction or whatever. The thing to look at is what is called the beta. The beta number basically means how much does it move compared to the overall stock market. So comparatively to the overall stock market, Johnson & Johnson moves 0.4. If you get a number that is 1 means you are moving directly with the stock market. Anything higher than 1 means the stock's going to move more. Anything less than 1 means the stock's going to move less. So the beta number here tells you how much movement we expect to have in the stock. And for example, you can take a look at the year to date here. It's actually up a good amount, about 17%. It's really impressive. But I think it's because a lot of people flood to these stocks when we have those kind of fears in the market. We have selling pressures. We have corrections. People flood to these safe haven dividend stocks because they don't move as much compared to the growth ones. So I think that's why partly Johnson & Johnson has been up almost 17% year to date, which is absolutely phenomenal returns for a little over halfway through a whole year in the stock market here. But But what I want to talk about is comparing Johnson & Johnson to, say, ticker symbol NVIDIA. And NVIDIA is basically in a very, very similar price point here, as it will eventually load. Literally almost the exact same price here, but has a beta of 2.13, which means that NVIDIA is going to be moving almost probably about 2 times, maybe as much, or have some sort of significant move compared to the overall market. So if SPY and the NASDAQ are up, 0.18 and 0.2, NVIDIA's up 1.4. Has a lot more movement to the upside. Also means there's a lot more movement to the downside. So what does this mean for the options chain and for premiums? Well, let's take a look at an example here. So let's take a look at, say, Johnson & Johnson. Johnson & Johnson, here's our ticker symbol that we have right here. And what we're looking at is maybe selling the cash secured put. Let's keep it consistent. I guess we can go to about 30 days out, the 22nd of August. We'll go about 30 days out here. If you were to sell the 160 strike price here, which means you get it for $9 cheaper, or even the 165, like why not, right? If you were to sell the 165 strike price here with Johnson & Johnson, you would get paid out about, I don't know what's in between 82 and 97 off the top of my head. What is that, a $15 difference? Cut it in half. Looking at about like $88, $89 share basically for this position. She's looking at basically about $89 share you would get in premium up front. But again, you would have to then be assigned and have cash for $16,500 because, again, as a result, you need to have the cash available in case it goes to 165. That gives you a return of, and I'm doing the math on my calculator right now, 0.54%. 0.54% return in a month, which is not that good because, again, the average return of the S&P 500 is about 10%. If you did this trade annualized over and over again, every single month for 12 months, you're looking at literally about like a 6.5% return here. It's like, okay, but why is that the case? Well, that's the case because, again, think about it. It's a stock that doesn't move much. We looked at the beta earlier, and it was 0.4, whatever the case was. I don't feel like going back to it now. But it was like 0.4. There's not a lot of movement with Johnson & Johnson. Again, look, it's moving 0.06. It moved 10 cents so far today in the market. 10 cents. Woo! You wanted to come down about $4 in a matter of a month. The implied volatility here is super low because, again, it doesn't move much. And this lower implied volatility number, 13.86%, it's probably not going to hit. It's unlikely. It's a delta of 0.23, which means it's going to be very unlikely for it to happen here. And there's not a lot of volatility in these options here because there's not a lot going on. We don't expect Johnson & Johnson to move much as a stock overall. Okay. So let's pull up the NVIDIA chart now, right? Let's take a look at the NVIDIA options chain here. Again, we'll do the same strike price with the same expiration date, and you'll hopefully see the difference. Again, remember, NVIDIA's beta that I do have up still, 2.13, about 5 times more than the beta of Johnson & Johnson, which was 0.4. Same expiration date, same strike price. And look at the payout difference. First of all, your implied volatility is a lot higher, 40%. Which is like, 3 times as much as Johnson & Johnson's. The delta is a little bit higher, so there's a little more risk involved. And with a little bit more risk, there's obviously a little bit more reward. That's how these option chains pay out. The higher the risk, the higher the reward. That's what we're looking for. And that's what people talk about when they're selling options. You're looking for those high implied volatility plays to sell options with, right? So let's say we got filled at $515 here for this premium. Divide by 16,500, you're looking at about a 3% return, 3.12% return. Same strike, same expiration, 2 different tickers, and the difference is massive. 0.5% return on Johnson & Johnson, 3.12% return on NVIDIA. That's the idea behind it, is that the higher implied volatility plays have a lot higher of a payout as a result. That's how it will always be. And again, the implied volatility, you have a high implied volatility, that means that there's going to be some crazy move. For example, Intel. Intel, as we know, will be having their earnings coming out after market close today at the time we're recording this video here. And take a look at the options chain. Look at the implied volatility numbers here. 150% implied volatility. 150% we're looking at right now. And the idea behind it that we're looking for here is that the implied volatility, again, because they're going to have earnings, this stock is going to swing in some direction. We don't know what it's going to do yet. Maybe it swings up 5%, down 10%. We don't know. But it puts you at risk of being assigned on a cash secured put. So they'll give you a higher premium as a result. You're looking at, as an example, this is 1 day, so it'll expire tomorrow. You could sell a $22 cash secured put here. It's at $22.72 right now. And you can get over a 2% return in 1 day. Because the implied volatility is so high, those returns are amazing. And just to even give you more understanding about this, a good ticker that I was looking at recently is ACHR, Archer Aviations. The reason why I'm looking at this one is because I want you to take a look at the options chain between August 1st and August 8th. Okay? And the reason why is because their earnings, I don't know if they have it over here or not. Let me see here. Their earnings are between the 6th and the 11th. We don't really know quite just yet, but the earnings are between the 6th and the 11th. Well, the 8th is earnings week for them, or around the earnings week. The 1st is before earnings week. And again, as we get closer to earnings, the implied volatility expands. So you're going to see juicier premiums because you have more significant moves. So let's take a look at an example here. Say I was looking at this before actually. For August 1st, so 8 days away, if I want to sell the $10 strike price, I'm looking at getting about $12 here, which is about a 1.2% return on this. Again, $1,000. Because again, $10 per share, 100 shares, $1,000, $12 divided by 1,000 share, or divided by 1,000 gives you about 1.2% return. So you get 1.2% return for an 8-day option here. Look at let me go back here. Implied volatility 73%. Okay, implied volatility 73. Let's go to the 8th. Same strike price, triple the premium, higher implied volatility. Why is that? We got earnings in this window somehow. And as you'll get closer and closer to the earnings date, I wouldn't be surprised. You will probably see this actually go even higher. So by pushing it out an extra week from 8 days to 15 days, you're getting actually a potential triple premium return compared to the other one. From $12 now to $34, you're looking at almost 3 times more because implied volatility is going to be higher and you have earnings. So that's the idea behind it. The slower moving stocks, Johnson & Johnson, Procter & Gamble is another one that doesn't move up. That's Apple. Fridge, you're so stupid. So say we want to go to Procter & Gamble, again, same thing. Even if you went, to the 29th of August, same thing. Again, not much of an implied volatility you're looking at. You're looking at about 20%. The returns aren't really that much better. Procter & Gamble moves a little bit more, I'm going to guess. And take a look here really quick at the beta before we get out of here. Procter & Gamble, again, Johnson & Johnson was 0.4. Procter & Gamble is also 0.4. So they're about the exact same thing here. So about a similar-ish return you might possibly get here. But again, that lower implied volatility makes a huge difference. And if you want to take a look at SPY, for example, SPY's options don't have much volatility at all. Okay? 14%, 13%, very, very low returns, very, very low premiums comparatively to these options here. Again, you're like, oh my God, $600. Yeah, but you need $60,000 up front in case you get assigned, which you don't want it. If you don't have it, you're in trouble. But so those higher implied volatilities. So for example, I have a chart here that's a bunch of, growth stocks that I'm looking at doing. Upexi, for example, I sold a cash secure put. I sold 2 of them at $5 each. Again, you're looking at about an 8% return here because the implied volatility is so high. So that is kind of the idea behind it. Again, the higher the risk, the higher that implied volatility, because that means your stock's going to have a lot more movements, which means there's more risk of you being assigned. If there's more risk for you being assigned, that means that they're going to have to pay you a higher premium to take on that risk. So that's kind of the idea to look at. So you want to kind of look at stocks, look at the betas, look at how they're moving, look at the returns, and base it off of your risk tolerance and how you want to secure some cash here. So I hope this makes sense to you guys. If you made this far in the video, as always, feel free to like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. I hope you're making money in the market as per usual, whether it's through growth stocks or through just buying and holding. And as always, I will see you guys in the next video.